Hey traders, Akil here. Welcome to another episode of the Trading Edge video. If you guys are new, I am a professional trader. I'm also a trading coach over at tier1trading.com. And the Trading Edge is a daily video that we put out to both our trial and our premium members, showing the ideas that are on our radar for the day ahead. And during the weekend, well, when I have the time, I try to come together and put together a free one for YouTube, kind of showing you some of the ideas on my radar for the week ahead. Now, if you guys are new, I ask that you do 3 things, maybe 4 things. First of all, subscribe to the channel, right? Takes a second, just hit that subscribe button below. That way you don't miss any of the content that I produce. While you're at it, subscribe to my buddy Jason Greystone's channel as well. But also 3 other things, right? Hit that like button, leave a comment underneath letting me know how awesome I am, right? We all know that our pride and ego and our self-esteem is purely driven off of the amount of social media kudos that we get. And lastly, share this video with a trading buddy of yours on any social media platform. So share a story of yourself watching it on Instagram, right? Retweet it on Twitter, right? You never know who's paying attention. And we've run into many traders who have signed up with us and have gone on to become consistently profitable traders, all because they saw some random person retweet it on social media or share it on social media. So it's more important than you think. Now, today is going to be kind of a follow-up on the Trading Edge video that I did on Thursday. So if you're a Tier 1 trial or premium member, this is going to be familiar. I'll try to kind of give you guys some background information as well for you guys that didn't get a chance to see that video. We're going to start off on the pound yen, but we're going to start off by talking about the euro yen. And the pound yen and the euro yen were 2 very similar trades, right? Thursday was called Super Thursday. There was a lot of news that came out from the ECB, Bank of England, and we saw a lot of movement in the market. And my whole philosophy, I am a technical trader, so I believe in technical analysis, but I do understand the part that fundamentals trade. And my philosophy has always been this: fundamentals are the driver, technicals are the destination. So the technicals on the chart, and for me that's supply and demand, support and resistance levels, they will tell you where price is likely to go. However, right, the fundamental news that happens can often push price to that level faster or slower, right? And Super Thursday was one of those days where we had a lot of news came out and we saw a lot of volatility in the market. So price was moving very strongly and very directionally. And we said to our traders, here are a few levels to look at as price runs into resistance for some structure-based counter trend trading opportunities. And the euro yen was one of them. This was kind of the better setup, but the more dangerous setup. It was a better setup because it was more of a CTS trade, combined technical scoring trade. We had more lining up at this level. Not only did we have previous structure looking left, you can see in this area right here around our green box, but we also had a 1-to-1 measured move. This is called an AB equals CD pattern. And you'll often see that the market kind of move, when it moves harmonically, you'll see the market move in equal distances and equal lengths and in many times equal time as well. And those are just clues that we can add to build our case for entry. Now, if you guys remember, the one kind of red flag we had with this setup was the fact, and we'll jump out to the daily here, was the fact that we had multiple levels of structure, right? So if we look at our chart here, this was the main level of structure that we were looking at for our potential trading opportunity. But if you look left, right, because structure leaves clues, you'll see that we also had a spike high right here, and we also have another spike high up there. And what I did was I gave a warning to our traders. So you have to be careful of these levels because these are very sneaky levels where you enter a position based on structure, you put in a stop loss above structure, which is a technique that we teach, and you think you're safe. However, because of that sneaky hidden level of structure that exists a little bit further back, those are often areas where people get stop hunted. And what I mean is this: if we go down to our 4-hour chart, right, you'll see our level of structure right here. let's say a trader hid their stop loss right above that level, right above the 131 even handle, 131.04, right? So not only are you above structure, but you're also above a high psychological number, right? Even handles are psychological numbers, numbers that our minds and our brains are often gravitated to, right? 0 zeros, 5 zeros, 2 fives, right? Quarters, thirds, all that stuff. And it looks like you're safe. And then the market spikes up, it stops you out, and then reverses, and you're like, oh man, I was right, but I was wrong. I don't know how to feel. I feel good because I was right. The market did what I expected, but I feel bad because I was wrong and I lost money. And you ask yourself, why? Oh, I would stop hunt it. The market just got me. And this was something that I did a lot in the past. If you guys are new, right? I am no super trader, right? I've been a consistently profitable trader for a long time now, but I'm not a super trader. And I didn't have any formal education. My trading knowledge comes from two places. One, I did get educated. I found me a mentor shortly into my career after, say, kind of my first 2 years of struggling. I found me a mentor that taught me the right tools of the trade, no pun intended, and taught me the right practices to do in order to become consistently profitable. And a lot of my lessons come from just the school of hard knocks, right? Being in the market and doing dumb stuff. I did so much dumb stuff that I ran out of dumb stuff to do, right? And I eventually got good just because I was so bad that I couldn't get any worse. And one of the things that used to take my money was doing this. And something that we preach in the practice of becoming successful, whether it's in trading or whether it's in life, but especially with trading, because as a trader, you are an entrepreneur, right? First and foremost, you have no boss, right? You dictate your own actions. There's no one telling you what to do. But it's also important that you evaluate yourself. So a practice that I do after every trade is I go back and I evaluate it. I look at the trade. I say, what did I do good? What could I have done better? Was there any changes in my analysis? And a handful of other things. And over time, I would notice that I continuously be skunked out of this position. When I say skunked out, I mean stopped out, because, skunks stink, being stopped out and then reversed upon stinks, kind of a terminology I use, skunked out. I noticed I was consistently being skunked out of this position. And I noticed that this would often happen when there was another level of structure looking left, and I would be trapped in here. And eventually I wisened up and I started being very cautious and even not taking trades or adjusting them accordingly like this. So hopefully by me passing down that lesson to you, it's going to stop some of you guys from making that same mistake. Some of you are going to ignore it and do it anyway. But hopefully some of you guys are listening and taking notes and saying, okay, this is something I want to pay attention to when I analyze the market. So that was a good lesson on the euro yen. The pound yen was basically the same type of setup, right? Price action had come up to previous structure. You can see my green box over here. You can see kind of my notes. And we started to reverse off of that level. Let me just kind of delete this. So we're looking for a reversal at this level, right? We're looking for previous structure resistance to hold and to see some type of relief. This is a counter trend trading tactic. And as counter trend traders, right, we're not looking for a full reversal in trend. So I'm not looking for the market to stop here, reverse, and go all the way down for that big home run trade so I can take a screenshot on my mobile device and post it on social media and tell you guys how good I am, right? No, right? We're looking for a short little area of relief. And with structure being the basis of my philosophy in the markets, I always look for previous levels of structure on where I project that relief to come to. So I'm looking for a move essentially, right? We have structure right here sitting at 145.87. We just talked about even handled numbers. On top of that, basically 146 even is where I would look for price to go. And what you can do here, right? Because I know some of you are saying, well, Akil, we've already started rallying down. Like, isn't it too late? Well, you wait for your next opportunity. And one of the things we teach over at Tier 1 Trading is just different ways to attack a trade. There's always a checklist, right? If then, right? You have first strike, second strike, third strike entries. And what that means is, it also has to do with how conservative or how aggressive you want to be as a trader. But what it means is that you have kind of tiers, levels of entry tactics, right? You look for your first entry tactic. If that doesn't happen, boom, look for number 2. If that doesn't happen, look for number 3. If that doesn't happen, look for number 4. Eventually you run out, but you give yourself different opportunities to look to take advantage of the trade. And that's part of being a well-rounded trader. So one thing you would look for here is a simple pattern formation called a double top. So you have price action coming up the previous structure. Our RSI, which is our relative strength index, has gone overbought. We're now looking for a retest of structure like that, giving us a double top. It'd be great if we saw some divergence. Divergence is when your price chart and your indicator or oscillator are doing separate things. So in this case, price action would be putting in equal highs, but your indicator down here would be putting in lower highs, right? You can see kind of divergence here as well. If we take our most recent new structure high right here and measure it out to our, if we take our past new structure high, I should say, and measure it out to our most recent new structure high, you can see that price action is obviously getting higher. However, on our RSI here, right, we take a look at these levels, our RSI is getting lower. That's another way of looking at divergence as well. But that's going to be a way to get involved in the trade. Again, looking at a retest of structure, looking for an entry at that retest of structure, and then once again, you allow yourself to involve yourself in a position in an area where the risk reward makes sense. So if you were to trade it down here and you're only looking for a retest at this level, risk reward is not going to be too great, is it? However, if you can get involved up in this level, hide stops above your previous structure highs here, of course, a rules-based way of hiding stops. Just don't put stops at this literal mark. We had a lot of conversations this week about people watching my content and just doing exactly what they see on the chart and not knowing why. So you always want to have a reason why. But you can see you can get about a 1.5 to 1 risk reward, obviously depending on if or when that double top happens. And well, if that double top breaks, so I guess if that double top does break, we'll come back with another Trading Edge video during the week, and I'll show you guys how to take advantage of it if the double top breaks or never happens and previous structure resistance is broken, because that would set up a trend continuation situation. But we'll worry about that during the week, either myself or Jason Greystone. So that's one opportunity here on the pound yen. Another one I want to follow up on is the Aussie dollar. If you guys remember, Aussie dollar, we were looking for a head and shoulders bottom. I'm not going to go through the full background again. Again, you can watch the last Trading Edge video from this past Thursday about that. But we're looking for a potential reversal in trend here on the Aussie. And you can see we're putting in a pattern formation called a head and shoulders, right? Where we have the market extend down. We have a very deep retracement back up. And now we're looking to put in a potential right shoulder. And what we're anticipating here, and it's not a head and shoulders yet, right? But we're getting there. What we're looking for here is a break of our neckline. You can see this red horizontal line I drew, and this is our neckline. And it's a very important level of structure, right? I call it a structure swap. If you guys are followers of Peter Brandt, he calls it an ice zone. I love that terminology, because if you can imagine an iced over pond, right? This is your level of ice. If you're below the ice, if you're a fish in the water, that level of ice is stopping you from getting to the surface. If you're above the ice and you're walking on it, it's stopping you from falling into the pond. And that's what we're seeing with support and resistance. Price comes down, we find previous structure support holds, right? We're not able to get into the water, break the ice, right? Price action comes down again, support holds. And then finally, boom, we break below the ice. Support then turns to resistance as price tries to break back up. That level of ice on the top stops it from getting above water, and we start trading below. So what we're looking for here with the head and shoulders pattern, this head and shoulders bottom, is a break of this ice zone, a break of this structure swap, a break of this structure level, this red line. There we go. We're looking for a break of this level and a termination of the previous trend and the start of the next bullish trend. And if we can get a break, a violation of this level, there are ways you can trade at the right shoulder. Again, I always say it's a very risky way because it's not technically a head and shoulders pattern yet. But if you're, depending on what type of trader you are, you could trade it here. I know we have a trader on the platform, Chris. I shared his video a few weeks ago. He trades them at the right shoulder, I believe. So it's doable, just not the safest way. So you have to be very careful about how you do it. But if we get past this red line, I would expect a continuation up to the 73 even handle, and potentially even 74 is a little bit high, even to about this level. So there's going to be lots of room here. There's going to be room from essentially 72.31s all the way up to 73 flat, all the way up to, for extended targets, even about 73.50. So something to keep your eye on for this week. Again, nothing necessarily right now, right? But keep your eye for a reversal at this level. Keep your eye on how price reacts as it gets to this ice zone up here. And for you guys that are familiar with the Head and Shoulders, we have our lowering RSI as well. You can see, right, the lowest low right here, higher low, and I would anticipate a higher low right here if we indeed see that reversal. Lastly, I want to take a quick look at Bitcoin. Not a Bitcoin trader, but I look at it from time to time, and this has a very long-term pattern setting up on it. So we're going to jump out to the daily. And what we have here on Bitcoin, I probably talked about this before, we have a descending triangle, right? A massive descending triangle. Now, again, I'm not a Bitcoin trader. I'm not familiar on Bitcoin. I don't know the up and up and what's happening and blah, 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 blah. But as a technical analyst, this is a pattern in which we would anticipate a bearish breakout. If we get a violation of our low line right here, this low horizontal line of support, I would anticipate a move lower all the way to maybe the 3,000 level, just based off how these patterns should perform when they break. And the psychology is like this because this is a pattern that I used to think the opposite direction, right? In the past, you always hear about, oh, well, the more time structure holds, the more powerful it is. I don't know where I read that or who I saw that from, probably a random YouTube video, but it's actually not true. It's actually the opposite, depending how it forms. In this particular formation, right, you look at it like this. The buyers are protecting this level, right? They're protecting these lows right here, right? Meaning each time price action goes down to these lows, right, we see buying pressure enter the market. It's pushing it up, it's pushing it up, it's pushing it up. But if we take a look at the opposite side of the market, pay attention to what's happening, right? So the buyers come down and they push the market up all the way up to here, right? Pretty good push, about 50% of the previous drop off, right? They push it down, or the sellers try to push down again, right? And again, it's all about a battle between buying pressure and selling pressure, right? The buyers react once again. They hold this level. They say, hey, buying pressure into the market. We push it up again. Now, what do you notice about the second rally in comparison to the first rally? It's lower, right? So the buyers were able to push it up, but they weren't able to push it up the same distance. So less strength. You can look at it as either less strength by the buyers or the sellers were able to beat that rally back down at a lower level. And then the market comes back down again. Sellers try to push. They still can't break this level. Buyers react. And then look at that. Lower once again, right? And each time the buyers are protecting this level and they try to rally off of there, they're doing so with less and less strength. And the psychology behind this pattern is eventually, right, if you're doing something, if you are a buyer and you're consistently buying, right, buy, and you see that your result is basically losing momentum, it's getting worse and worse and worse, it's only a matter of time before what happens? You give up. It's only a matter of time before you give up and you say, you know what? I'm going to come back to fight another battle. I'm obviously losing this one. No point in wasting any more money chasing something that doesn't really look optimistic. And eventually you see a breakout to the downside. Now, will this happen? We don't know. And that's why we always want to wait for confirmation. You could position yourself, say, up here. If we get a retracement up here, you could position yourself in advance and get an amazing risk reward on this pair. Because if this theory is right, just to give you some perspective, if this theory is right, price shouldn't put in, right, a higher high. And we talked about a potential breakout all the way down to the 3,000 level, right? You can see a massive risk reward on here, right? These are the opportunities I like to take because I don't have to be right that much to make a lot of money, right? Historically, if you guys are new, I'm about a 55% trader, right? And I know a lot of people out there, you got to be 90%, you got to be 80%. It's not true. You can be that. You can be 90% and be consistently profitable. You could be 90% and lose money. You can be 20% and lose money. You can be 20% and be consistently profitable. A lot of the greatest traders of all time typically range between 20 and 40% with their hit rate, right? So I'm not a very high win percentage trader. I like to win more than I lose, obviously. Mentally, keeps me sane. But I like to put myself in positions where when I lose, it's only a little bit. When I win, it's a lot of it. So every win makes up for a handful of losses. And I love trading like that. So if we do get a retracement up here, you could look for that type of situation for a big rally down. The safer way would be to wait for the confirmed break, right? Wait for the violation of that previous level of support, and then either sell it on the breakout after that or wait for maybe a retest of structure and then a continuation down. But again, another one that is long-term, something to keep an eye on is Bitcoin here on the daily for that massive potential bearish break. So that's it for today, guys. I hope you guys enjoyed the video. If you did, do me a favor, right? Again, these videos are free. It takes a few hours out of my weekend to do this. But, you know, it's worth it if you guys are enjoying it. Just let me know. And the ways you can do that is by hitting that subscribe button, sharing this video, and then leaving a comment below. That is a massive help. It kind of gives me that motivational push to be like, you know, on days where I'm like, I don't feel like doing one this week, to read the comments and be like, you know what? Someone just got something very important out of this. And if I can reach and help one person each week, it's well worth it. So do that. It'll be a massive help to myself. And of course, if you're interested in working with us closer, seeing these type of videos on a daily basis, make sure you check out that $1 trial over at tier1trading.com. You get 2 weeks on the platform. You get the daily video. You get a bunch of other stuff, including access to 2 live rooms, access to some pretty cool trading software, and a chance to really just sponge off of a professional trading environment for 14 straight days. I guarantee your trading is going to be better than when you were going in. So if you guys can do that for me, I'll be back next week with another episode of the Weekend Trading Edge. And until then, plan your trade, trade your plan. Take care, gang.